The Eurodollar system runs your life. And the proof is a day when the price of money exploded in a few hours, with no recession, no war, no dramatic headline that most people remember. On September 17th, 2019, the overnight funding world cracked a benchmark overnight funding rate that had been sitting around 2.43%, suddenly jumped above 5%. And some trades printed near 10%. The New York Fed stepped in with a $75 billion repo operation because the plumbing was choking. Most people heard none of that. But if you owned stocks, if you owned bonds, if you ran a business, if you had a mortgage, you lived inside the consequences. Because when the overnight price of money jumps from 2.43% to above 5% in a day, that is not a small technical issue. That is the system telling you something important. The real dollar supply is not a neat pile controlled by one button. It is a web of private promises, and when trust wobbles, the web tightens like a fist. You did that. You trusted the word dollar like it meant one thing. You saved yourself the stress of thinking about how dollars are created outside the United States. You saved yourself the boredom of learning the difference between a currency and a dollar claim. You paid when the system reminded everyone that the price of dollars is not just set by the Fed. It is set by the private market's willingness to lend, roll, and swap dollars in the shadows. If you stay, you are going to get the one diagram that makes this whole machine obvious. And you are going to get the 3 dials you can track that warn you before the next shortage hits. And once you understand those dials, you will understand why the world can feel like it is running out of dollars, even when the US is printing money. Now, before you can understand the shortage, you have to earn the definition, because the word Eurodollar sounds like a European thing, and that is how it tricks people. A Eurodollar is not a euro. A Eurodollar is not a currency issued by Europe. A Eurodollar is a dollar IOU created outside the US banking reserve system. It is the same label dollar, but stored in a different warehouse. It is like buying a gold bar and leaving it in someone else's basement. The receipt says gold, the label is familiar, but the risk is different because access depends on the basement door, not on your belief. That is the first mind shift. The dollar you see in your checking account is one kind of dollar claim. The dollar that a bank in London lends to a company in Brazil is another kind of dollar claim. The dollar that gets borrowed overnight through wholesale funding is another kind of dollar claim. And the dollar that gets promised through an FX swap is another kind of dollar claim. All of them wear the same costume. Not all of them behave the same when the room fills with smoke. You did that. You treated every dollar like a cash bill in your pocket. You saved the effort of seeing the difference between a dollar and a promise to deliver a dollar. You paid because modern finance runs on promises, and promises get repriced in fear. Now, let's put the first hard number on the screen, because this is where the invisible becomes measurable as of the first quarter of 2025. US dollar credit to borrowers outside the United States was about $13.7 trillion. 13.7 trillion. That is not a small side market. That is a global backbone. Now, do the simplest stress test, the one nobody wants to do because it makes the system feel too real. If the effective cost of dollar funding rises by 1 percentage point on 13.7 trillion, the gross annual interest burden rises by about $137 billion. That is $137 billion a year of extra cost that has to come from somewhere. It comes out of profits. It comes out of wages. It comes out of investment. It comes out of growth. It comes out of the exact companies and countries people think are far away from the Fed. You did that. You enjoyed a world where borrowing in dollars felt normal. You saved money on interest when dollars were abundant. You paid because abundance trains borrowers to depend on it, and dependence is fragile. Now here is the second number. The one that makes your stomach drop when you really understand it. A massive share of the dollar system does not show up as traditional loans on a normal balance sheet. It shows up as obligations to deliver dollars through derivatives, especially FX swaps. The number discussed in the data is not billions. It is tens of trillions. There have been estimates of more than $80 trillion in obligations to deliver US dollars hidden in FX swaps, forwards, and currency swaps. And by the end of 2024, outstanding FX swaps and related instruments were reported around $111 trillion. 111 trillion. That does not mean $111 trillion of cash is sitting somewhere. It means the world is promised contractually to deliver dollars across time at scale that dwarfs the normal banking story. This is the hidden mortgage book of global finance. It is like the world took out a second mortgage on the same house, then forgot to tell the neighbors because it was all in the fine print. You did that. You looked at debt like it only exists when it sits as a loan on a balance sheet. You saved yourself from learning how derivatives create obligations that behave like debt in a crisis. You paid because the biggest margin call is often the debt you cannot see until it demands cash. Now, do not panic at the numbers yet. Understand the mechanics, because the mechanics explain why shortages happen. An FX swap is a simple idea. One party wants dollars today and can provide another currency today. So they exchange currencies today and they agree to swap back later at a set rate. In calm chimis, this is treated like plumbing. But in stress, this becomes the heart of the shortage, because the shortage is not always about the Fed not printing. The shortage is about the private market refusing to roll the promises at the same terms. When volatility rises, counterparties demand more collateral. When collateral demands rise, the cost of obtaining dollars rises. When the cost of obtaining dollars rises, weaker borrowers scramble. When weaker borrowers scramble, lenders tighten further. That is the squeeze. So dollar shortage is not always a shortage of paper. It is a shortage of willingness to lend, willingness to roll, willingness to accept risk, and that willingness can evaporate in hours. That is why September 2019 matters, because there was no apocalyptic headline. Yet overnight funding rates spiked, and the Fed had to inject $75 billion in a day to calm the market. That is a private system telling the public system, we are not clearing at normal terms right now. You did that. You assume the Fed sets the price of money and everything. You saved yourself the headache of learning that markets can spike above the target when plumbing constraints hit. You paid because those spikes are the first tremors before bigger cracks. Now, let me give you a picture you can hold in your mind. Imagine the dollar system as a city. The Fed controls a big reservoir in the city. That reservoir is powerful. But the city also has a huge private network of water towers and pipes owned by companies and neighborhoods. The private network supplies most of the day-to-day water in many districts, especially outside the United States. When everything is calm, no one cares who owns the pipes. When a drought hits, the private owners start locking valves. They do not lock valves because they are evil. They lock valves because they are afraid. And the moment they lock valves, the price of water spikes in the districts dependent on that private network. The Fed can pour water from the reservoir, but it does not own all the pipes the water needs to travel through. So the real constraint becomes the pipes, the collateral, the trust chain. This is why you can get a shortage even when the Fed is easing, because easing does not automatically rebuild trust chains at the speed of panic. Now we bring in the event that proves the Fed's true job. In 2020, when global stress hit, central bank swap lines exploded. At the peak in late May 2020, swap line usage reached around $450 billion. That is the Fed lending dollars to other central banks. So those central banks could lend dollars to their banks. So those banks could stop scrambling for dollars in the private market. That is the Fed acting as a global lender of last resort, even if nobody wants to say that sentence out loud. You did that. You thought swap lines were a technical footnote. You saved yourself from seeing what it means when $450 billion of emergency dollar lending becomes necessary. You paid because it proves the system runs on offshore dollar liabilities that can demand rescue when trust breaks. Now, here's the part that makes this story dangerous for your portfolio if you do not understand it. In calm periods, the offshore dollar machine expands because it is profitable. Borrowers outside the US borrow in dollars because dollar funding can be cheap and abundant. Lenders like it because it creates yield and activity. Investors like it because it creates growth. Markets like it because it feels like a tailwind. But calm is when leverage grows. Calm is when hidden obligations pile up. Calm is when the system builds a taller stack of promises that only works if rolling stays easy. Then stress hits and the stack suddenly demands real dollars, real collateral, real funding, and that is when you see the dollar become stronger even while everyone says the dollar's finished. Because in a shortage, the currency people need most is the currency that rises. Not because it is loved, because it is owed. This is the part of the story that flips your intuition. People argue about the dollar like it is a brand, but in a crisis, the dollar behaves like a debt instrument. If the world owes dollars, the world must buy dollars to settle. That buying pressure strengthens the dollar. You did that. You believed the dollar's value is only about US politics. You saved yourself from tracking global dollar debt. You paid because the dollar can rally in the exact moment your narrative says it should die, simply because the world is covering liabilities. Now, let us make it personal with a clean ledger beat that hits like a receipt. You bought risk assets in calm times because liquidity felt endless. You saved money because credit spreads were tight and funding was cheap. You paid when liquidity tightened because the first thing that happens in a dollar squeeze is that the price of leverage rises and everything priced on leverage revalues. That is why a Eurodollar squeeze can hit US tech stocks, emerging market bonds, crypto, real estate, and commodities all in the same season. Different assets, same funding, heartbeat. Now, if you are wondering why this matters for geopolitics and the petrodollar story, here is the answer. When countries talk about de-dollarization, they often talk about invoicing trade in another currency. But the Eurodollar system is the deeper layer. It is the funding layer. It is the layer that decides whether a country can refinance, whether a bank can roll, whether an importer can pay, whether a commodity trader can hedge, whether a government can survive a sudden stop. So the real question is not, can you print a new currency? The real question is, can you fund yourself without offshore dollars at scale through stress? And that is why bypass systems grow slowly, because replacing invoicing is easier than replacing funding. Replacing a label is easier than replacing a warehouse. You did that. You assumed changing the currency of trade ends dependence. You saved yourself from learning that dependence is deeper in funding, hedging, and collateral. You paid because the world can shout about new currencies while still borrowing and hedging in dollars. Now, here is the next promise, and you are going to earn it. In a minute, you are going to get the 3 dials that show Eurodollar stress before the headlines, and you are going to get this simple test that tells you whether the next squeeze is likely to be mild, serious, or violent. But before that, you need one more piece, because without it, you will misread the signals. The Eurodollar system is not one market. It is a stack. It includes bank loans, wholesale funding, repo, commercial paper, FX swaps, and the shadow banking system that intermediates collateral. And a huge share of modern finance has migrated toward non-bank players. Non-bank financial institutions now sit on a massive share of global financial assets, with an estimate around $256.8 trillion and about 51% of global financial assets. That matters because non-bank players are often more sensitive to margin calls and funding runs. They do not have the same backstops. They do not have the same deposit base. They are often funded short and invested long. So when volatility rises, they can be forced sellers, and forced sellers are how stress spreads. You did that. You looked at the banking system and assumed risk was mostly regulated and contained. You saved yourself from tracking the non-bank layer. You paid because the non-bank layer can amplify shocks through margin calls and forced selling. Now we can connect it back to a date you lived through. March 2020. When stress hit, the problem was not only that people wanted safety. The problem was that everyone wanted the same thing at once. They wanted dollars. They wanted treasury collateral. They wanted to unwind risk. They wanted to meet margin. They wanted to roll funding. And the private system tightened. So the Fed responded with tools that looked domestic but behaved global. Swap lines, repo, liquidity facilities, because the alternative was a disorderly scramble for dollars. Now, if you are still with me, do one small thing right now. Like the video and subscribe, not because you owe me anything, but because the next episode after this one will show you how to watch the squeeze forming in real time, so you can stop being surprised by the same pattern every cycle. And share this with one friend who thinks the dollar is only about America, because the Eurodollar system is the real global dollar supply mechanism. Now, here is the cliffhanger question that sets up the rest of the story. If offshore dollar credit is $13.7 trillion, and hidden dollar obligations and FX swaps are in the tens of trillions with total outstanding around 111 trillion, then what exactly tells you when the system is about to tighten? What tells you before the panic? What tells you before the forced selling? What tells you before the dollar shortage headline that always arrives late? That is what we are going to build next. We are going to build the 3-dial scoreboard. We are going to translate it into what it means for stocks you can actually buy, like Group and Intercontinental Exchange and the hedging layer, and Banks like JP Morgan and Citi in the funding layer, and collateral plumbing players like BNY Mellon and State Street in the custody and settlement layer. And we are going to do it with the same brutal simplicity as a household budget. You saved stability by trusting the plumbing. Now you are going to learn how to read the pressure gauge so you can stop paying tuition every time the invisible market decides to remind everyone that dollars are not just printed. They are promised. Now, we build the pressure gauge because once you can read it, you stop being surprised by the same pattern dressed in different headlines. The Eurodollar squeeze never announces itself with a siren first. It announces itself with small changes in boring places. And those boring places are where the real money already sits. So the first dial is simple. How fast is offshore dollar credit growing? Not the story you've heard on social media, the actual pace of dollar liabilities outside the United States. When dollar credit to non-US borrowers is expanding, the system is adding promises. When it is slowing, the system is pulling promises back. And when it reverses, the system is demanding repayment in the one thing everyone owes, dollars. If offshore dollar credit is $13.7 trillion, you do not need a collapse to feel pain. A 0.50% change in funding costs on $13.7 trillion is about $68.5 billion per year. That is the size of a major industry's entire profit pool, disappearing into interest expense and hedging costs. You did that? You looked at global growth like it comes from productivity alone. You saved the effort of tracking global funding conditions. You paid because a big part of growth is just cheap rolling credit. And when rolling credit gets expensive, the growth story changes. Now, the second dial is the price of secured funding, because secured funding is the heartbeat of modern finance. People think of finance like it is stocks and bonds, but the real heart is collateral. Repo, overnight money, the place where someone hands over safe collateral and borrows cash for a night. And when that market hiccups, it tells you the whole system is starting to cough. Remember the 2019 spike, SOFR around 2.43% to above 5%, prints near 10%. That is not a normal move. That is a signal that someone could not get cash against collateral at the usual price. That is the sound of a jam in the gears. When that happens, the first thing that breaks is leverage, because leverage is fed by overnight funding. If your entire strategy depends on rolling cheap overnight financing, a spike like that is not a chart. It is a margin call. And margin calls create forced selling. Forced selling is how stress spreads from one corner to the entire room. You did that. You enjoyed leverage indirectly through the market. You saved time by not asking how your favorite assets are financed. You pay because the day repo spikes is the day the market starts asking who is swimming naked. Now the third dial is the hidden dollar rent, the cost of swapping currencies into dollars. This is where the shortage hides before it becomes visible. The FX swap market, the cross-currency basis, the place where someone outside the US says I have euros or yen or won, but I need dollars to pay a dollar bill, and I need them now. In calm chimis, that conversion is cheap. In stress, it becomes expensive. And the moment it becomes expensive, every borrower who assumed they could always roll cheap dollars starts discovering that the price of dollars is not fixed. It is auctioned. So when you see the basis widen, when you see swap costs spike around quarter end, when you see hedging demand surge, that is the early warning that the private system is tightening the valves. You did that. You assumed currency markets are separate from your stocks. You saved yourself the pain of learning that funding is the spine of every asset class. You paid because the swap market can tighten first and the stock market only understands it later. Now put these three dials together and the whole machine becomes predictable. When offshore dollar credit is growing fast, when repo is calm, and when FX swap costs are stable, the system feels generous. Risk assets float, spreads tighten, people feel smart. That is not genius. That is abundant rolling funding. But the generosity creates its own vulnerability, because the bigger the offshore dollar machine grows, the bigger the future demand for dollars becomes when everyone tries to reduce risk at once. So the worst time to be arrogant is the calm time. Calm is when the seeds are planted. Now let me show you the exact sequence that repeats, because once you can recognize the sequence, you stop acting like every crisis is new. First, the world builds dollar obligations because dollars are cheap and liquid. Companies borrow in dollars even if their revenues are not in dollars. Funds take leverage because volatility is low. Banks and non-bank players intermediate collateral because the spread looks free. Second, something changes the risk mood. Sometimes it is inflation. Sometimes it is geopolitics. Sometimes it is a policy surprise. Sometimes it is just the calendar and balance sheet constraints at quarter end. Third, lenders demand more collateral and better terms. Fourth, the cost of dollars rises in the private market. Fifth, weaker borrowers scramble for dollars. Sixth, forced selling begins. Seventh, the dollar strengthens not because it is loved, but because it is needed. Eighth, the Fed and other central banks step in with tools not to make people rich, but to stop the plumbing from freezing. You did that. You watched the movie at the end. When headlines screamed, you saved yourself from watching the quiet first scenes. You paid because by the time the headline arrives, the best opportunities and the worst risks are already in motion. Now, this is where we talk about who controls the tap, because people love to ask who really controls the dollar, and the Eurodollar system gives you the honest answer. In normal times, nobody controls it fully. It is controlled by incentives. Banks create dollar credit because it is profitable. Funds create synthetic dollar exposure because it is profitable. Companies borrow because it is profitable. The tap is 1,000 private valves. But in stress, the tap becomes one big lever because the system demands a backstop. And that is why the Fed's emergency role matters. Swap lines near $450 billion in May 2020 is not a footnote. It is the receipt that the world S dollar liabilities can become the Fed's problem when the private system refuses to roll them smoothly. You did that. You thought global finance runs on independent countries making independent choices. You saved yourself from seeing that global finance runs on one shared liability language, the dollar. You've paid because when the shared liability language tightens, everyone feels it, including people who never borrowed a dollar directly. Now, let us bring this into late 2025, because the biggest mistake people make is thinking 2019 and 2020 were one-time events. They were demonstrations the machine still exists. There are periods where year-end funding stress was discussed openly, and the Fed's balance sheet actions in bills and repo conditions were part of the conversation about keeping the turn-of-year.com. That tells you something plain. If the system was naturally stable, it would not need repeated seasonal calming. A car that needs the mechanic every time you go on the highway is not a car you call perfectly healthy. It is a car you call managed. You did that. You believed stability means the problem is gone. You saved yourself from noticing that stability often means someone is actively holding the roof up. You paid because when the support is removed at the wrong time, the roof drops. Now, we bring this down to the companies you can actually point to, because viewers do not come here only to understand the machine. They come here to understand who gets rich when the machine is calm and who gets rich when the machine tightens. Start with the simplest winners when volatility and hedging demand rise. CME Group, Intercontinental Exchange. These are not the companies with the loudest headlines. These are the toll booths on risk transfer. When the world becomes more uncertain, more people hedge. When more people hedge, volumes rise. When volumes rise, exchanges and clearinghouses collect fees. If a volatility event increases derivatives volume by 20% and an exchange earns a few dollars per contract across millions of contracts, the incremental revenue can be real because the cost base is partly fixed. That creates operating leverage. You did that. You chased exciting stories. You saved yourself from noticing that boring toll booths can print cash when everyone else panics. You paid because the crowd buys the drama and misses the infrastructure. Now move to the collateral and custody plumbing. Benai Mellon, State Street. These firms live in the world of settlement, custody, collateral management, and money market plumbing. When stress rises, collateral becomes king. When collateral becomes king, custody and collateral services become more valuable. When funding strains, institutions scramble for the safest collateral and the cleanest settlement. This is where the boring infrastructure can quietly become more important. Now move to the banks that intermediate the system. JP Morgan, Citi, Goldman Sachs, Morgan Stanley. They are major players in FX rates, prime brokerage, and funding intermediation. In ComChimis, they earn on spreads, activity, and structured flows. In stress, activity can surge, but risk also risks. So the bank story is not a simple up story. It is a scale and risk management story. Big banks can earn a lot when volatility rises, but they can also get hit if they are on the wrong side of a funding squeeze or if counterparty risk spikes. This is why in stress, you watch not only earnings, but funding profiles and exposures. You did that. You treated banks like simple interest rate bets. You saved time by not learning the difference between a bank that funds itself safely and a bank that relies on fragile wholesale confidence. You paid because the market punishes fragility fast. Now move to the non-bank layer because it is impossible to understand modern squeezes without it. Non-bank financial institutions hold a massive share of global financial assets, and they are often large users of FX swaps and wholesale funding. When volatility rises, margin requirements rise. When margin requirements rise, someone must post cash. When someone must post cash, they sell what they can, not what they want. This is how good assets get dumped with bad assets. This is how contagion happens. If you want a simple way to think about it, think of the non-bank system like a crowd standing on a thin platform. In calm weather, the platform holds. In a storm, everyone leans in the same direction and the platform cracks. You did that. You assumed risk is mainly in the regulated banks. You saved yourself from tracking the shadow layer. You paid because the shadow layer is where runs can start without warning. Now we take it to the household ledger. Because this story is not only about institutions, it decides your life through the discount rate. When the Eurodollar system tightens, global funding costs rise. When global funding costs rise, the discount rate rises. When the discount rate rises, long duration assets get hit first. That means the stocks whose valuations depend heavily on future earnings far out in time. If a company is priced at a high multiple because people are discounting future cash flows at a low rate and the discount rate rises, the present value drops. That is not a moral judgment. That is math. A simple lens is this. If a stock S valuation assumes a discount rate of 6% and the market reprices to 8%, the present value of far future cash flows falls sharply. That is why liquidity squeezes can crush growth stocks, even when the company's product is fine. You did that. You fell in love with the story of a company. You saved yourself from watching the rate and funding environment that prices the story. You paid because even great companies can fall hard when the price of money changes. Now, here is the practical behavior that people who survive do, and they do it without drama. They avoid being forced. They keep liquidity so they do not have to sell at the bottom. If your monthly expenses are $3,000, 6 months is $18,000. That $18,000 is not about return. It is about freedom from being forced to sell a good asset at a bad time. They reduce leverage that cannot survive a normal shock. If a 20% drawdown wipes you out, your plan was not a plan, it was a wish. They diversify by mechanism, not by headlines. Mechanism means what happens to the asset when the dollar tightens. What happens when repo spikes? What happens when volatility rises? What happens when the dollar strengthens because liabilities are being covered? They prefer pricing power and balance sheet strength. Because in a funding squeeze, weak margins get crushed. If a company has a 5% operating margin and a funding and hedging shock equals 1% of revenue, operating profit drops about 20%. If a company has a 25% margin, the same shock is about 4%. That is why quality matters more in a multi-rail leverage-heavy world. You did that. You bought what was popular. You saved yourself from reading balance sheets. You paid because balance sheets decide who survives when the price of money jumps. Now, let us cash out the deepest point of the entire Eurodollar story, the one most people never grasp. The dollar is not only a currency, it is a unit of account for global debt and hedging. So the reason the dollarization is slow is not because the world loves America. It is because the world is entangled in dollar liabilities and dollar hedging infrastructure. Changing the invoice currency is easy. Changing the liability language is hard. Changing the collateral language is brutal. And changing the crisis exit is the hardest of all. That is why a post-dollar world can still be a dollar or a shortage world. Because the system can build bypasses and still owe dollars. You did that. You thought currency politics could rewrite funding overnight. You saved yourself from seeing that funding is a habit built over decades. You paid because the habit can snap back violently in every crisis. Now we close by giving you the prize answer you came for. Stated simply, how do you know the next Eurodollar squeeze is coming? You watch offshore dollar credit growth. If it accelerates while risk appetite is euphoric, vulnerability is building. You watch repo stability. If overnight rates start acting strange, if spikes appear around quarter end, if secured funding becomes jumpy, the gears are grinding. You watch FX swap pressure, if cross-currency costs widen, if basis moves sharply, if hedging demand surges, the private system is tightening. You watch the dollar's behavior if the dollar starts strengthening while risk assets wobble. That can be the signature of global dollar short covering. And you watch forced selling indicators, volatility rising, credit spreads widening, money market fund inflows surging. These are the footprints of fear moving into cash. You did that. You waited for the headline. You saved yourself from watching the gauges. You paid with surprise losses and missed opportunities. Now you do the opposite. You watch the gauges. You keep liquidity. You keep your leverage survivable. You own some toll booths that benefit from volatility and hedging. You own quality cash flow assets that can survive higher discount rates. You stop confusing calm with safety, because Gautam is often just a period when the system builds the next tall stack of promises. If this episode made the machine click, hit like and subscribe. Share it with one friend who thinks the dollar is just a printing press, because the Eurodollar system is the private multiplier that matters. And share it with one friend who thinks de-dollarization means the dollar is doomed tomorrow, because the offshore dollar market is why the dollar can get stronger in the exact moment everyone says it should die. And now you know why? Because the world does not only hold dollars, the world owes dollars. And when the room fills with smoke, everyone runs toward what they owe, not what they claim to love.